With my experience and your ambitions, let's navigate the world of business, making informed choices and capitalizing on every opportunity. Welcome to Profit or Pitfall, where we unravel the intricate threads of business deals. The last few episodes, I've been going through some commercial real estate diligence, but today, just based on the whole idea of Profit or Pitfall is to kind of use live deals that are going on that come in my desk from existing or new clients. And I wanted to dissect two financial offers that are common in the restaurant business sector, which is an industry that I'm pretty familiar with and do a lot of work with for various clients here in Southern California and across the US. And a lot of the times what you'll come across is a merchant cash advance and the working capital line of credit. And so today I wanted to walk through it because it can be a little bit deceiving in terms of kind of how the numbers look and maybe how you understand what the numbers mean. And so I want to set the stage because this is an actual thing that I have a client in the restaurant space. He's at a crossroads. He's weighing up an offer from a merchant cash advance lender against an existing working capital line of credit. So what's the difference? Well, potentially it's a whopping $100,000 over 2 years. So what I want to do today is peel back the layers. And so we'll delve into the details. So let's talk about what's the difference between merchant cash advance or MCA and working capital. And so I look at MCA as factoring, and you're deducting a percentage from your daily credit card sales in return for upfront funding. So you're basically discounting your work. And a revolving line of credit, you're basically getting a fixed amount of money and you have access to it to fund your operational needs. You don't have to use all of it at once. When it comes to collateral, like what are you offering in return? For an MCA, it's basically your credit card sales. For a working capital line of credit, it's typically unsecured, but it may be backed by restaurant assets or future sales in some cases. Now here's the best part, and I'll show you kind of, I have a little graphic that I've put here where you kind of got the fat roll and you got the thin roll, right? And if you look at a typical line of credit, something that I've offered, you normally can get to a loan size of about $1 million. Now these are unsecured deals. We're not talking about SBA. I'll talk about that at the end of today's episode. And so what I have seen is when I come and somebody else is asking for assistance where they don't want to go through the SBA process, and in today's market where banks are very, very tight, it's very hard to get a loan, or they want to run you through a bunch of traps. It's going to take you 60 days, 75 days to get something funded. These can be very attractive when it comes to these working capital lines of credit because oftentimes they can look at your bank statements. Maybe they'll look at 1 or 2 tax returns, but very quickly ask a few questions and get you funded within a couple of weeks. But as you can see here, the working capital lines of credit have a longer repayment term. And when you look at the merchant cash advance, the average loan size is much smaller. And the repayment term is often much shorter. And today we're going to use an example, this is a real example, to help you, or in this case, my client, make a good decision. So when it comes to duration for merchant cash advance, they're tied to your daily sales until the full amount is repaid. So that can be as short as 90 days based on the rate of sales. When it comes to the working capital line of credit, it's flexible. It's often revolving, so it's allowing for continuous borrowing up to that limit for 36 months, let's say, for that amortization. So if you think about fractions, the bigger, if the denominator is bigger, it's less intensive in terms of when it comes to how much you have to repay each week or each month. So when it comes to cost, it's normally for an MCA, it's a fee. It's based as a percentage of daily sales. And it can accumulate to be quite high over the term because you have no prepayment capacity. So if they say, okay, your factor is 0.05 or 1.05, they're charging you the full amount up front. When it comes to for a working capital line of credit, the interest is only on the amount you borrow, not on the entire credit line. So if we look at comparing apples to apples, $250,000, you're already going to get hit with that factor rate up front. Plus, you're discounting your work when it comes to the MCA. When it comes to the working capital line of credit, okay, you got approved for $250,000, but maybe you only need the first 50 grand because you're doing a tenant improvement or you need to buy out a partner or something like that. So the rates can vary based on lender and the restaurant's financial health. So here's, I think, the most important part is the payment structure. For an MCA, the daily deductions are from the credit card sales, right? So until the entire advance is paid plus the fee, you have no real flexibility. With a working capital line of credit, you've got regular repayments. And some can be monthly or weekly or otherwise, but depending on the agreement, but it's a little bit more dependable in terms of what it's going to look like each week or each month. Now, when it comes to accessibility, MCA is suited for restaurants with consistent daily credit card sales, even if they have weaker credit profiles, which is often the case. When you see somebody going after an MCA is because maybe their FICO got hit because they had a late mortgage payment or a late car payment, and it got hit 50, 60 points, and all of a sudden you're below what a traditional bank wants to see, or even some of these working capital line of credit players that are out there, they're just not going to offer it. And so the MCA is a great way to get you the capital you need, but it comes at a significant cost, because the working capital line of credit is going to require a decent credit profile or some type of track record, either specifics that can be different among lenders. But for example, if the restaurant's been around for 1 year versus 10 years, that gives a big difference, or if the owner owns property or not. When it comes to flexibility, merchant cash advance is basically completely dependent on your daily sales volume, whereas the working capital line of credit is highly flexible. You borrow as you need up to that credit limit. You can repay and borrow again as often as necessary, right? When it comes to the purpose, like I mentioned, it's often for immediate operational needs or to capitalize on a short-term opportunity. Maybe you got an opportunity to buy a really nice piece of equipment for the kitchen, and it's at an auction, and you need to show up tomorrow afternoon. And so your bank's not gonna give that to you because you're gonna wait 45 to 60 days. Working capital is nice because you're covering those various operational costs for inventory or supplies to pay renovations, but you also have that capacity to react quickly in a situation where maybe there's a short-term opportunity for the business. When it comes to the impact on cash flow, MCA can be significant, especially during high sales periods, as a consistent percentage is taken daily. When it comes to the working capital line of credit, it's consistent and predictable. It's based on the agreed repayment schedule. If it's 36 months, you know that you're going to have 36 payments that are based on whatever the outstanding balance is, not what the whole line of credit is. So you're not paying interest on $250,000, you're paying on what the balance is at the end of that month. So if you're figuring out, how do I make a good decision? Because I think sometimes what you'll see is when you look at the factor rate, it can be kind of confusing. Like, man, it looks cheaper than, maybe what the interest rate on this line of credit looks like. So one thing I would say is that when it comes to the line of credit is that you have the perk of 100% tax deduction on your interest. On the other hand, microloans or MCA are based on factoring credit sales, right? So that's the food, that's the tax, that's the tips. And that's the catch. Factoring is forcing you to discount your hard work. In the restaurant business where margins are already thin, this could be a recipe for disaster. So let's take a look at the real cost. If you took, say, $250,000 from the MCA with their 90-day term, which is pretty typical, you're looking at a pretty hefty repayment. And let's look at the little chart that I put together here. So what I've done is I've looked at, to kind of help you kind of compare apples to apples, is here's MCA and here's the line of credit. So if you look at, for example, here's the factor, and you say, oh, well, 1.05, well, that seems like a lot cheaper than the 13.5% that the lender is charging me. Well, that can be kind of confusing, because if you look at the actual amount of repaid, the weekly repayment is almost $22,000 versus $3,700 on the working capital line of credit. That's significant in terms of how you manage your cash flow. You look at the annual factor in terms of the interest cost, it's about $50,000. Now looks cheaper here compared to the line of credit, right? It's $50,000 versus $67,500. But when you annualize those numbers, that's kind of where, for me, in trying to explain how money works for a client, is that when you annualize that number, you're really paying about 22% for the money that you're borrowing, because if you want to compare apples to apples, this is a 90-day term. Well, if you take 90 divided by 365, that's 4 point something, or 365 divided by 90, excuse me, that's 4.0 something. You got to multiply that to be able to compare apples to apples. And so when you realize that, for the factor rate, for the untrained eye, a factor can sometimes seem cheaper because the numbers look smaller than interest rates. However, when you convert that to an equivalent APR, it's significantly higher. And I'll show you there as you kind of see the visual on how that's supposed to work. And like I mentioned before, for a revolving line of credit, the actual interest cost depends on how much of that credit you're actually using. So here's where things get interesting. With the MCA, you're looking at monthly debt service about $87,500, right? That's incredible. I mean, I think some businesses wouldn't make it to the end of the month. If you see here, the repayment, there's the monthly payment, approximately $87,000, because this is a 90-day loan plus the interest rate, right? Versus $14,000 or $15,000 for the the working capital line of credit. So that is how you have to take into account that there's a significant monthly cash flow difference here. And those are the hidden pitfalls that merchant cash advance has. There are definitely some quirks. Their variable term can change your actual cost. So sometimes you'll see they'll have promotions like, we only charge you half off on appetizers during happy hour. Well, you're effectively paying them twice due to the factoring model, right? So, and the clincher there is that they can also switch up their rates. They can go anywhere from 11% to a literal jaw-dropping 100%. I mean, that is a very common thing, because it's not interest, it's a reduction or a discount against what it is you were offering as a meal. So what does this all mean? The aggressive repayment structure of short-term loans like a merchant cash advance can jeopardize a business's ability to meet their current financial obligations. And business financing isn't about who offers the lowest rates up front. It's about understanding the nuance, the potential pitfalls, and the long-term implications, which means you really have to read that contract, all that small print. Oftentimes, these MCA contracts are like 19, 20 pages long. And so in the realm of business deals, knowledge is truly power. So if you're looking for capital, we can help you understand these types of offers. And like I mentioned earlier, there's also the SBA that can step in and even offer a longer term at 10 years. And if there's real estate involved, up to 25 years, which makes even more attractive because the rates are much lower. You're right now, even in this high interest rate environment and high inflation market like we have today, you can still get a 504, an SBA 504 if there's real estate involved. Rates are in the 6s or 7s. So compared to the 13 or 20%. All these products have a very particular reason, and you want to make sure that the why in terms of how you're choosing it is for the right reason, and that maybe you have a strategy. I've done deals where a client has stepped into an MCA or some of these working capital lines of credit that have what I call high octane interest rates, but I'll certainly will help them move to the next level, which is, okay, you're able to put out that fire, you bought that piece of equipment at a significant discount, whatever it was, or you wanted to make sure you made payroll, but now let's get you into that next level, which is, doing the hard work of working, with an SBA lender and kind of going through those traps of submitting your tax returns and answering questions, but you're getting that significantly discounted rate. So Make sure that you're asking good questions, and you want to use a broker like me who understands how these things work and also has the relationships. You wouldn't believe how different banks are just in one city or one region, and how their capacity and appetite changes. And so a guy like me has those relationships, talking to chief credit officers, chief lending officers, or the people in the region, kind of understand where I should take certain deals to make sure the client gets the best. I hope that was helpful. Thank you for joining Profit or Pitfall. If you have a deal that you would like for me to look at, there's a link in the comments there. Feel free to submit it, and maybe you'll be in our next episode. We'll see you soon.